Only mode.
Good evening, everyone. Welcome to Admiral Markets. My name is Chris. Thank you for joining us on the 6th of August, where I take a look at mastering the waves of Forex. Now, because my microphone is new, I just want to quickly check if you hear me properly. Is there a good sound? Or is there some echo, perhaps, when I speak? So if you could write okay, if the sound is okay, or good. And if it's bad, write bad. Okay, I have most of you saying okay. One person says echo. 4 saying good. All right. So it looks to be okay. I'll put the microphone just a tad further away, so perhaps the echo will be less. All right. Hope the sound is acceptable for all of you. So we're going to be taking a look at mastering the waves of Forex. I'm very excited about this topic because I love waves. I talk a lot about waves in live webinars with Admiral Markets and in my daily wave analysis. So I think this is going to be a great time with you. Before we start though, be aware of this disclaimer. This webinar is intended for a global audience. It may not be suitable for everyone. To get the corresponding information on charting conditions and other details, please visit admiralmarketsglobal.com, select your country of residence, and contact an appropriate entity. Also, trading foreign exchange and global financial markets is considered high risk and may not be suitable for everyone. Please seek the advice of an independent financial advisor for more information on that. This webinar is not advice and is for informational and educational purposes only. And by continuing watching this webinar, you agree with this disclaimer and you are aware of the risks involved when trading. Once again, this is hosted by Admiral Markets, so thank you for that. We got a great MT4 Supreme Edition that you might want to take a look at. Go to admiralmarkets.com and take a look at the homepage. You can click there on MT4 Supreme. You'll find out more information about that. Nanette will not be in this webinar today. It will be only me on waves. Here you can see, for instance, click on Find Out More, and you'll get more information about the Supreme Edition, 56 additional features for your trading. Also, if you're interested in helping Admiral Markets, if you think Admiral Markets deserves the title of being the best broker, or perhaps the best analysis, or best education, or customer service, or anything else, then we would highly appreciate your vote in the UK Forex Awards. And if you already voted, thank you so much. The voting stops tomorrow. Either today is the last day or tomorrow is the last day. Either of the two. I don't think Saturday it's possible anymore, for sure. But either today or tomorrow is the last chance. All right, so our agenda for today, we're going to take a look at an introduction of waves. Waves analysis is quite a broad topic. We got a two-part series for you. So part 1 is today, part 2 is next week. But in all honesty, I think to cover all points, all angles, with sufficient examples, with sufficient explanations, with Q&As, 2 is not enough. All right, to be honest, it doesn't cover the topic. But I'm going to do my best to be efficient and to make as much as we can within those 2 sessions of an hour, and to give you a robust understanding. And then the next step would be probably to take it yourself and take that knowledge and go deeper, and maybe join our wave analysis, our wave webinar sometimes, or live webinars, for instance. After that, we're going to talk about wave psychology. In any case, wave step by step, look at wave patterns, wave rules, and wave guidelines. That's all lined up for today in the next 55 minutes. Next week, we're going to talk about which tools are good for waves, how can you make wave analysis, how can you use waves for trading purposes and exit purposes, and the wave risk management. All right, starting out with waves. Very cool, excited about it, because we're going to talk about many interesting topics. For instance, we're going to talk about understanding the basics. That's basically the goal of this 2-part webinar. Is first of all, understanding the basics, then how to manage the learning process. Because as I said already, I cannot give you all the details of all the the wave material. It will be too complex and too much, to be honest, right? So deeper studying will be required after this, but I hope to give you a good layer, a good starting point, and then I will add basically how you should kind of continue with that process. If you're interested, you want to, get experience from a day-to-day point of view, Admiral Markets has wave analysis provided by myself. Go to, that's actually the wrong link. Sorry for that. But Admiral Markets has an analysis part, and just click on wave analysis. I'll show you the link in just a second. All right. And of course, you can follow Twitter to see the newest wave analysis on a daily basis, Admiral Markets or myself. You can also join the weekly wave analysis. Oh, all right. Just send an email to info@admiralmarkets.com to receive weekly emails with long-term wave analysis on Mondays. So we have daily wave analysis on the website, but the weekly wave analysis is sent directly to your email and is not on the website. So that's how you can continue after these two webinars if you're interested. Now the wave analysis you can find, by the way, go to analytics, go to admiralmarkets.com, click on analytics, and click on wave analysis. All right, let's start. The peaks and valleys, we have them many times in the market, not only the Forex market, but all markets. All right, but especially in Forex, we see many ups and downs, price making falls and rises and momentums and something like on this chart, right? And the green dots kind of showing the swings here that occur on all time frames. So, many traders get frustrated, right, by these ups and downs and have problems with them from a psychological point, sticking to their plan, and it just causes, a lot of insecurity. And I think we've all had this issue at one point or another. All right, so I think this is something that we all recognize. These spikes, these sustainable moves, continuation moves, reversals, and it's difficult to explain if we don't know the wave analysis. Wave analysis helps tremendously with understanding the market and understanding why it's making these patterns. Okay? The email address is just the basic info@admiralmarkets.com, or you can go to admiralmarkets.com and try to reach, click on contact us. For instance, here at the right upper corner, you see contact us. That should lead to a contact. Okay? info@admiralmarkets.com. All right. So the wave theory helps with understanding and giving understanding of what's going on in the market. All right. And the wave theory has been created by Ralph Nielsen Elliott in the 1930s. So it exists already quite a while. And he wrote in his first book, The Wave Principle, in 1938. He then had a second book about some 8 years later. And he wrote about this wave theory that explains the market movements. So it's a theory on market behavior, basically. And his book explains that. What is the theory? Well, basically, Mr. Elliott proposed that the market prices unfold in specific patterns, which he called waves. So it's very much like, for instance, patterns that we see like chart patterns, right? Or candlestick patterns. They belong to the pattern family. Other important elements of technical analysis, support and resistance, and trends. And the third thing is patterns, right? Patterns occur very consistently in the market. And besides candle and chart patterns are wave patterns, all right? So they're part of the pattern group. Now, there's a lot of criticism on Elliott Wave principle and whether it indeed can help us make pips, make money, and indeed can help with predictions perhaps, right? The criticism is basically geared towards the fact that a lot of the wave knowledge or wave ideas are in retrospect, right? In retrospect, we see this was a wave 1 or this was a wave 3. In retrospect, we can see that was a good trade, all right? But the criticism is deeper. It's not only on waves, but it's sometimes even geared towards the whole branch of technical analysis. Can technical analysis help with trading purposes, or is the market just making a random kind of noise up and down, and is it impossible to make predictions or find good trades based on technicals, and is it just random movements that the market is making? Now, if you think it's random, then obviously you're not going to do technical analysis. Now, obviously, I don't believe that. I believe in technical analysis because I see it playing out day by day. And if I look at other walks of life, like, for instance, weather forecasts, they're extremely capable of making forecasts up to 7 days. Now, a lot of people maybe still make jokes about weather forecasts, but tests show that accurate forecasts are possible up to 7 days. So I think the same is valid for trading, right? The same patterns, the same can be valid for the market, right? To a certain degree, we can make estimates up to a time horizon, right? For instance, up to 7 days, maybe on a 4-hour chart, right, or a daily chart, and maybe up to 7 months on a monthly chart. Obviously, the further you go into the future, the more difficult it is to be accurate with your forecast, just like it is with weather, right? But past data, yes, does give information about the future, because we use past data in all circumstances to estimate economics, to estimate the company potential. We all rely on past data. Saying that past data is not relevant for markets and price, that means that we can throw overboard all of our current methods, because we constantly use past data. We constantly use historic data to make predictions about the future. There is no other way. So this is a bit select criticism from these people, in my opinion, that say that it's not possible with price, but do not criticize perhaps other walks of, branches of theory and science. Okay. No. Anyhow, wave theory in general, it's true that a lot of things sometimes change in retrospect, but that's not very important. As long as we use it efficiently and find high probability moments with wave theory, it's still a very useful addition. And yes, it's not going to be perfect in all cases, no. But as long as we recognize the high probable moments, then that's okay. All right. So that's my thoughts on criticism. A bit longer than I wanted to, but all right. So the trader psychology is behind the wave movements. That pushes the market psychology. That explains basically why price makes those waves. And it's a fluctuation between optimism and pessimism. All right. When the market is optimistic, we see bullish movements, and when it's pessimistic, we see bearish movements. But those movements also occur in different forms. Price can move quick or corrective, right? So that's a slow movement, and it's the heartbeat of the market. Fast, slow, fast, slow. So what we see basically is either price is making a bullish momentum, either a bullish correction, either a bearish momentum, or either a bearish correction. These are basically the 4 types of price movement that we see on the chart. There is really nothing else that we can see. These are the 4 combinations, and that's it. So very simply put, wave analysis is just about having an idea what type of price action has happened in the past and how that can be linked to the current and next one. That's it. It's really, if you look at the core, it's not that complicated. All it's saying is, oh, the previous one was bullish momentum. Then I see a bearish correction. Then I see another bullish momentum. Maybe this one will be again a bearish correction. That's it. It's just linking these swings, linking these legs, and labeling them. So wave theory sounds a lot more complicated, I think, than it should be or necessarily has to be. It can be, at its core, just simply seen as looking at these 4 elements. So for instance, I see momentum and I see correction, right? What would be the most likely move after that? Well, perhaps a bullish momentum again, right? As price often continues in the direction when it makes a slow move sideways. All right, it's not 100%, but it's a decent chance, a decent probability on this time frame. All right, so ignoring information from other time frames. So basically, it's just labeling like, okay, before that we had maybe this, and before that we had this, and you can look back, or you don't have to look back that long. You can keep it short or keep it long, as long as it kind of gives you an idea about what's happening now and what could happen in the future regarding whether it's bullish, bearish, or a momentum correction. So this is not that complicated, if you agree with me. Do you follow me on this? So when people say, wave theory is too much, it's too complicated, then what I suggest is taking a look at it, from a simpler point of view. Start at its core and then work from there. Okay? All right, here's an example, maybe a bit better than my drawings, because this is a chart. This is a euro-dollar 4-hour chart. And yeah, you can see that purple arrow, that's momentum, right? And you see black arrows to the upside, that's bullish correction. You see green arrows, that's bullish momentum. You see an orange arrow, that looks more like a correction, right? To the downside, a bearish correction. So the very first point is, can you recognize it? I already gave you the answers, right? But would you have known the answers beforehand? First of all, of course, we need to be able to recognize what's what before we can actually say what the current swing could be or what the next swing could be. We need to see what the past swings are. Because if we think that the purple line is a bearish correction, well then obviously we're starting on the wrong foot. We need to understand what the past is and accurately be able to label those things. Now, I don't think that that's too complicated. I think that most of you will be probably able to do that. If not, start with that. Start learning this first. All right? Send me an email to chris_sworcik@hotmail.com. Right? I'll write that down in the chat. Send me your chart and label what you think is impulsive and corrective. And I'll check that for you and send you my feedback. If you think that that's something that you want help on. If you think that you're good in this, great. Right? Then you can move on. Here's more examples. At the bottom you see momentum, correction, momentum, correction, momentum, correction, momentum. All right? And it's all, as you can see, bearish momentum, bullish correction in this case. So this is the first task. All right, then we're going to label, of course, the last few swings. That will be basically the next step. First is to understand it, then is to look back at the chart you're looking and saying, okay, what are those swings? And then make prediction or make an idea about what the next swing could be. When you see momentum and a correction, in this case, maybe very likely indeed that momentum will continue to the downside. That would be an estimate. So this is, when I talk about waves in the webinar, often I actually talk about this part. All right, we're going to go deeper now, but I actually stop often at this because I want to show traders that I think that this is more or less the most important. Now, we still have a lot of information coming because we're going to dive into more and more detail. But does this make sense? Up to this point, I think it does, but does that make sense? Any questions on this part? And I emphasize this because often, in my humble opinion, when I talk to traders, I have a feeling that there's some kind of negative sentiment towards waves. Not with everyone, certainly with some traders, that I think kind of push this branch of analysis aside too quickly. And I think by making it more doable, by making it simpler, I think that it will be more valuable for more traders. Okay, so I only see one confirmation, but I hope everyone's on board as we go along. So next step is actually labeling waves. That's basically looking at what we've described as price action. We said this is a bullish momentum. So if it's a bullish momentum, what kind of label are we going to give it? Are we going to give it a wave 1, a wave 2, a wave 3, or wave 5, right? Because those are bullish momentums. Momentum is a 5-wave sequence. But within those 5 waves, wave 1, 3, and 5 are bullish momentum. 2 and 4 are correction. Of course, there's also bearish momentum. Same thing. Wave 1, 3, or 5 are momentum. 2 and 4 are bullish correction. But the momentum is a 5-wave pattern. All right. But within those 5 waves, wave 1 and 3 and 5 are the actual momentum. Okay. So in this case, you can see wave 1 momentum right here. Wave 3 momentum, wave 5 momentum, wave 5 momentum, right? And wave 2 sideways, wave 2 sideways, wave 4 sideways, wave 4 correction. Corrections can be in ABC, ABCDE, WXY. ABC basically is a single correction on its own. It's also called the zigzag, where you have often it's basically a correction with momentum, whereas WXY is a correction that is slow or corrective correction in a way. All right, it's linking multiple corrections together. Here you can see, for instance, that an ABC completes a bigger W, and this ABC completes a bigger Y, which completes a W. So you're linking multiple corrections with each other. ABC is a quick correction, WXY a slow one on average, and ABCDE is a triangle. Now, at any point in time, if you have questions, let me know, okay? Waves have internal counts. So when we see a 1, 2, 3, 4, 5, like in this case, for instance, looking at the green letters here, that's a wave 1, that's a wave 2, that's a wave 3, that's a wave 4, that's a wave 5. Okay, so what happens next? We have a 5-wave finishing. Well, that could, in this case, be part of a wave 3. In this example, it could be part of a wave 1, 2, it could be part of a wave 5. It could also be part of a wave A or C, because a wave A and C could be, as I said, a momentum correction. Those two have 5 waves. In this case, however, we see that it's part of a bigger wave 3, a black wave 3, that had a preceding wave 1, a preceding wave 2, followed by wave 4, and a wave 5. And the wave 5 has some extension here too, wave 1, 2, 1, 2, 3, 4, 5. And even a subwave, wave 1, 3, 4, 5. All right. Now, this wave 5 could be again part of a bigger wave. Could be again part of a bigger cycle. It's not mentioned here, so I don't know. Maybe it's part of a wave A of a bigger B correction. We don't see that here. All right. But the point is that we have higher cycles and lower cycles, no matter what time frame we look at, unless we're looking at the 1 minute, because that is, the smallest unit of time at least. All right, so as I said, these waves occur on all time frames, right? This is an example where I'm looking at the Euro-Dollar 1-hour chart and the Euro-Dollar 4-hour chart. The 1-hour chart is on the left, and you see that it's mentioning a WXY. If we look where those WXY are on a 4-hour chart, you can see that they are part of a green Y, you see, right here, which is part of a blue 4. So we see more information, we see more history. All of these letters, all of these numbers, and all of these colors represent, are labeling basically either a bullish momentum, bullish correction, or bearish momentum. And we connect them to make bigger labelings. And we connect them to make bigger understandings of what's going on. That's all. All right? So it's just a sequence of numbers and letters based on momentum, correction, bullish and bearish. So as you can see, what I'm trying to advocate is, in general, to keep it practical, right? To focus on the value of wave analysis for making analysis and perhaps for trading purposes, because that's basically what it boils down to. I mean, often enough, a lot of traders get into trouble or don't see value in it because they're expecting too much. First of all, they just start with wave analysis and they think by tomorrow they can use it for trading purposes already. They expect way too much. It takes a lot more time to learn it, and you need experience, just like in anything else, before you can actually make accurate judgments about probabilities using wave analysis. It's not 100% science. It's not something that will always give you a very black and white answer. It's most of the time probabilities, just like the branch of analysis, technical analysis is. In that way, they're the same. If you trade discretionary. If you trade non-discretionary, then you're just trading an edge and you have to keep at it, and because otherwise you might skew the system. So take your time to learn it. All right. Now, if you like detailed wave debates, that's great. I'm not criticizing you. By all means, keep doing that. But from a certain point of view, it's a great hobby. But I don't think it's needed to go into that great detail about wave counts, because I think you lose the practical common sense part of it. There's nothing wrong with it, but if you get bogged down by details too much, the wave analysis could actually become less useful for you. If you like it a lot, there's nothing wrong with it though. But I don't think it's needed to, as let's say a general user of wave analysis, I think it's not that useful. All right, so MOM, CRR is a abbreviation for momentum and correction. So I suggest start with a small part of each part, all right? And expand with more time frames. And then take it from there up to the point that you still think it's useful, up to the point that you think it still makes sense. And who knows, maybe 2 years from now you'll be a big wave fan and posting wave analysis and talking about different variations of waves and stuff like that. But maybe not. Maybe you'll just use it very practically. And both are fine. It really depends on your own view. So slowly you can expand that to the point you feel comfortable. All right? But don't expect too much too soon. Especially for trading purposes, use it especially for analysis. Wave analysis is the most useful for analysis purposes. Yes, it can sometimes be an additional support for trading ideas, but often enough, wave analysis is great for patterns, for recognizing direction, but for actual trading decisions, I think using other tools is better. Using a strategy like, for instance, trend lines or moving averages or fractals or range bars is more practical, I think, right? But it's great for analysis, great for understanding the patterns and understanding the market and just having a better clue of what's going on. Yes, it's possible to use for trading purposes too, and we will talk about it, but that's also more for experienced wave traders and perhaps in general less useful than analysis, all right? So that distinction I would like to make. But it is possible to use. I see that Harsh Marine is referring to a friend who uses Elliott Wave and it gets great R2Rs. So perfect, great stuff. So let's talk a bit about the wave characteristics. We talked about, I already mentioned the labeling, 1, 2, 3, 4, 5, the ABC, the WXY. So what does it mean? Well, basically, as you can see here, we have a classical 5 wave and a classical ABC correction. Most of us that know a bit about waves know this, right? Know that, okay, there's 5 waves and there's a 3-wave correction. So most of you recognize this. Now, let's talk about a bit why this happens. Now, wave 1 is often the starting point of the new direction. As you can see, prior to that, price was moving down. So often wave 1 is hesitant. Often wave 1 does not go all too far because it bumps into the resistance of the previous trend. In this case, it was a downtrend. So where does wave 1 stop? Well, it stops close to the top of the previous resistance. As you can see, there's a red box there. So often enough, you'll see price stop there or maybe right at it or break above it just a bit. This is probably an 888.6 fib when you place a fib on this very last swing high, swing low, right? So you do see some enthusiasm because wave 1 is showing some good upside. Look at that speed it's traveling. You see the difference of the angle of price. Just looking at the candles, if you put a line below those candle lows, do you see the angle of that trend line? And do you see the difference between the angle of this trend line and this trend line here, right? It's steeper. Also, there are multiple candles going up, whereas this, you can say, yeah, that's momentum too. It's a fast price action. But in my opinion, there's a difference because the difference is that it's one candle. If it's 1 or 2 candles, often enough, you're looking at a spike. If it's several candles in a row, 3 or more, then it's typically more considered to be a momentum. That's how I make the distinction. Here you see one big bar and then a pin bar, right? That's why I think this is a spike, 1 to 2. This is momentum. It has a steep angle and it has multiple solid, bigger sized bullish bars with closes near the high. You cannot see it too well, but believe me. And we got a good angle. So that is momentum. And it's a different character in that green circle than what we see here or here. That's a triangle, and this is a triangle, and this is a bear flag. Do you see that difference? So that's why we can say that's probably wave 1. What we also can do is dive into a lower time frame and look at wave 1 on the lower time frame and say, okay, this is what we're looking at is a weekly chart. How does the daily chart look like? And if the daily chart is showing a 5-wave pattern within wave 1, well then again, there's another clue that this is going to be a wave 1 or wave A, and we probably will see follow through to the upside. Does that make sense? Wave 2 is often, not so much in this case, but is often a deep correction. And why is that? Because the trend is still present, the old trend. So price is still going to make a deep correction because there's still a lot of sellers from that old direction, right? But it makes a deep correction, but then turns around again because the psychology has changed. We're going to revert into an uptrend. So you do see price moving up again after a deep retracement. And then typically we see a massive blast, a wave 3. Has a lot of power because that's where the biggest thrust should occur in a wave 3. That's where we have the biggest participation and the most drive. It's often the longest, never can be the shortest. Wave 4 is going to be often a slow, long, shallow correction. Market is hesitant. It saw a big move up, so it's not going to move down a lot, and it's just waiting for the last wave up, the 5th wave, which typically goes for a short run because the enthusiasm is already dying down. And we see often enough divergence between wave 3 and wave 5. And we can see that here too. If this is maybe a wave 3 and this is a wave 5, we see divergence between this and this. And the same here, between this and this. And between wave 1 and 3, we see convergence. And here, between 3 and 5, we see divergence, right? Okay. All right, now we have the correction. Now the correction, wave A, can be quick, relatively quick here. Now the wave B is a place where we often traders get into trouble because it's still with the old trend. But it fails to break the top, so we get this head and shoulders pattern and we make a deeper correction for wave C. So here's an example where we have, for instance, a live example of the pound dollar 4-hour chart, and you can see here an impulsive 5 wave, right? But it's part of a bigger corrective wave, a bigger ABC, which is actually part of a W and a part of an X and a part of a Y, right? It's part of a bigger correction, and that can happen. On a lower time frame, we could see impulse, but it could be part of a correction on a higher time frame. Or on a lower time frame, we can see correction, but it could be a pause within momentum of a higher time frame. All these momentums and corrections occur on all time frames, and they kind of fit as a jigsaw puzzle. So you can see, in this case, how much the momentum can push. Alrighty. I'm not sure about that software you're talking about, Harsh Marine. I don't know it, so I can't rate it. All right, so we're going to talk about rules and guidelines. Now, not all of them, because there's just lack of time. But we're going to talk about the 3 rules that exist and the guidelines I found the most important. So there are rules that we can use to our advantage to understand if our wave count is correct or not. And those rules basically are, they help us with making decisions. They help us with making understanding where the key levels are, so that we know if price breaks or bounces, what that does for our wave count. These rules cannot be broken, otherwise our wave count is, let's say, incorrect. All right? Wave counts will basically be valid until either a rule is broken or a guideline becomes the rule is broken, or it becomes just very unlikely that wave count is correct. Typically, wave counts, there could be many wave counts, not 1 or 2. There could be sometimes a couple of them valid at one point. When I, of course, look at the wave count, I submit or show the one that I think is the most likely, has the highest probability. Sometimes the margin is large. Sometimes I think it's very likely that this wave count is correct based on various factors: experience, price action, tools. Other times, it's not as clear. It's maybe sometimes 50-50. It could be this or that. And I then write that in the text. Sometimes it's, 2 wave counts could be equally likely, but they both point to the same direction. Let's say that this is either wave 1 or 2 or A or B. Well, it doesn't matter which one is correct, because both indicate that there's an upside potential after wave B or 2 is completed. So does it really matter if it's a C or 3? Not that much. It matters because it's only about how far that third leg can go. If it's a wave 3, it will go further. If it's a wave C, it will go not as far, most likely. So the only thing that changes is the target. But the entry, stop loss, as we'll discuss in next webinars, would not be that different, right? So sometimes the wave counts are clear, or at least clear for me. Sometimes it's not, the probability is not that great, and wave count can change easily, and that's okay because I'm not attaching a lot of probability to that count anyhow. Sometimes different scenarios are okay because they, as I said, both point to the same direction. Most important is that whenever there's a wave count, there's a clear invalidation level and confirmation level. So in this case, for instance, one of those rules is wave 2 cannot break the origin of wave 1. So obviously the origin of wave 1 is a very clear level, right there where I have the green circle. No doubt about it. If that level gets broken, then the wave 1 black here is invalidated. It's incorrect. What I thought was a wave 1 is not indeed a wave 1. Those things happen. I mean, it's not always, as I said, it's not always going to be correct. There's many times that things will have to be changed. But as long as we know that that support level is key, then we know whether it's correct or not. So wave 2 doesn't break the origin, so there's still that chance that indeed the wave 1, 2 is occurring. Now, when does wave 1 get confirmed? Most of the time, when you see a clear bounce off the bottom, candlestick pattern, bullish price action already, that's an early indication, right? Once price starts to make a higher high and higher low on that time frame, or perhaps even one time frame lower, then that's another confirmation, right? That price is moving into a new direction. Other thing, for instance, a trend line connecting these tops, when price breaks through that, another confirmation, right? That price is making a new direction. Another rule, wave 4 cannot enter into wave 1 territory. So, for instance, I have here a black wave 1, a black wave 2, the top of wave 1, where I have the red line, all right, wave 4 cannot go below that. It cannot enter into the wave 1 territory unless it's a corrective wave 1 or wave 5. That's an exception, all right? But wave 3 can never be corrective. It's always impulsive. Otherwise, it's not a wave 3. Most wave 1s, 3, and 5 are impulsive. And when they are impulsive, wave 4 cannot enter into wave 1 territory. So, what is the invalidation level for the wave 4? Well, the red horizontal line. That's clear. If price goes there, the analysis is wrong. If it doesn't go in there, the analysis can still be correct. Right? And another rule, wave 3 cannot be the shortest. It cannot be shorter than wave 1 and wave 5. Typically, it's the longest. Right? So what happens if wave 1 is this and wave 3 is this? Wave 5 cannot be longer than wave 3 because otherwise wave 3 is the shortest. So we know what the target could be, or what, in any case, the invalidation level would be of that wave count if it breaks above that length of pips. So you can, by using these rules, make conclusions about certain wave counts, certain spots, and levels that cannot be broken. These are the rules of the waves. Now, unfortunately, there are only 3, not many, but there are a lot of more guidelines that typically happen, but not always happen. All right, they're not 100%, but they occur mostly or often, and we can rely on them as a probability. And we can still make judgments and change the wave counts because of them. It's just that sometimes it maybe takes a bit more evidence, right? Every time new price action is on the chart, we get a new piece of information, a new clue about whether our expectations are correct and confirmed, or whether our expectations are being deteriorated, maybe are not being confirmed, and chances of a different wave count are increasing. It's always that balance. That's why, using wave counts, I use tools that I'll explain next week, like trend lines, for instance, to confirm when the wave 4 breakout is happening, right? Etc. Got a question, how do you know if the wave 3 will be longer than wave 5? Since wave 5 happens after wave 3. Well, the idea is that wave 3 cannot be the shortest. So typically wave 5 is not going to be longer than wave 3, but in any case, wave 3 cannot be the shortest. That's the rule. So how do you know if the wave 3 will be longer than wave 5? I'm not sure. How do you know if the wave 3 will be longer than wave 5? Well, you never know for sure if wave 3 will be longer than wave 5, right? But you're comparing wave 3 to wave 1 and 5. Wave 5 could be longer than wave 3, but wave 1 and 5 cannot be longer than 3. Does wave 1 start immediately after wave 5 or ABC? Wave 1 starts indeed after an ABC down, or a 5 wave completing, or a correction start ending here like a Y, or a triangle, an E as well. Well, if you're thinking about trading purposes, how can that rule help you? The wave 3 cannot be the shortest is, basically it's useful for targets. So if wave 1 has a certain length, right, and you expect a wave 3, then often enough wave 3 will pass the length of wave 1. That's how you can use it. All right? Now, if you're expecting a 5 wave, then you would, preferably try to hold on for the wave 5 and exit as soon as wave 3 top gets broken, right? Because you know that wave 5 doesn't go that far. You have limited expectations about what wave 5 could do because it doesn't go far. That's how you, in practical terms, would use it if you're expecting a 5 wave. So here's some more ideas. For instance, here, wave 1, all right, wave 2 can't go below the purple bottom. Once wave 1 gets broken, we're probably in a wave 3 or C, right? The blue line indicates where wave C would typically end. So if price stops there and doesn't continue, it's probably more of an ABC. If it passes the blue line, then we're probably looking more like a wave 3 because it's extended. It's passing the length of wave 1. Then we get a correction sideways. All right, so price cannot go back below the wave 1 territory. So then the orange level becomes important. That's an invalidation level. Right? And then we get one more boost, wave 5. So at first, the purple line is important, and the orange, the top. Then the blue, then again the orange for wave 4. And then somewhere in here, maybe a target. All right, let's talk a bit about, is the rules clear? Any questions about the rules? I know that maybe for some of you this is relatively basic stuff still, but the problem is that there's a whole group of people here, so who knows, it could be the first time that people are looking at waves, so need to start with the basics. But next week, I do want to dive into more advanced stuff. All right, guidelines. Well, cool. Enrique is saying it's clear. Great. So wave guidelines, they are not 100%, but most of the time are pretty accurate. Fibonacci levels, for instance, are very useful and go hand in hand with the waves. So they're very, very good supplement tools with each other. I'll talk about that next week too. Fibonacci, in fact, is almost a pity if you use Fibonacci not to understand waves a bit, because they are so supplementary, or they work so well together. As I said, here you can see wave 4 is typically shallow, corrective. So what is a typical Fibonacci level for wave 4? A 23.6 fib, a 38.2 fib. Shallow Fibonacci retracement levels. This is the Euro-dollar weekly chart. The big fall that we had, price is still in that correction as we speak on the Euro-dollar. So, wave 1, often deep, 61.8 fib, 78.6, 88.6 fib, right? Go far, even double bottom perhaps, but no break. No break, very important. All right, typically for wave 1, we'll see internal 5 waves. So, how to trade a wave 1? Well, take the bounce at the deep fib, or trade within the wave 1 still. Internal 5 waves. Trade the wave 3 of wave 1, or part of the 5 of wave 1. But then expect a deep pullback. Oh, sorry. That was wave 2 I was talking about. Wave 1, what I meant was 78, sorry, I got it mixed up. 78.6, what I meant is that wave 1 will go that deep against the previous swing. So if we had still a downtrend, for instance, then wave 1 will often go up to these levels before moving down still one more time and finding the wave 2. Sorry. So wave 1 will go far, but we'll find resistance, and this will be a 5-wave structure here. All right. Wave 2, deep, 61.8, as I said, 78.6, 88.6 fibs. All right. Wave 3 will go past the minus 1618.8 often. All right, should go far. Wave 4, shallow, 38.2, 23.6. Maybe the 50, but not further than the 50. If it goes below the 50 or above the 50, past the 50, I typically don't consider it a wave 4 anymore. It's possible. Technically, if it goes to the 61.8, all right, it doesn't have to invalidate the analysis necessarily. This could be a wave 1, this could be a wave 2, this could be a wave 3, and a very deep fib from here to here, like a 61.8, still doesn't cross into the territory of wave 1. Not invalidating a rule, but a guideline, it certainly is invalidating because it's not typical. And I doubt that it is a wave 4 when this happens. It still technically could be though, but the chances are just a lot smaller. And then the wave 5 would go typically to the minus 272 target. So when you have a wave 3, and then you get the wave 4, then typically the wave 5 goes to the minus 272 target here of this wave 3. Now, a lot of traders get into trouble because they see 5-wave pattern and they start fibbing the 5th wave. But we know that that's dangerous because we should expect a correction probably of this entire move. And we should fib it from entire swing high, swing low, not only this last part. Because what happens? We get 5-wave and we get an ABC that does this. And this fib doesn't work anymore. All right? So now obviously we do get, as a guideline, some waves get expanded. So we do want to realize that that could happen. All right? All right. Wave A's, B's, C's, WXY's. Well, A's, right, they typically also reach the same level as wave 1. They also have an internal wave 5. Wave B, if it's a zigzag, will not go that deep, 38.2, 50, 61.8. Wave C will go to a minus 272 target, a minus 61.8 target, but would not expand often further than the minus 61.8, because otherwise it's more and more looking like a wave 3. So those are the typical ratios of fibs for waves. Wave WXY, often deep corrections, double bottoms, double tops, even breaking the top or bottom, even going up to a 138.2 fib. All right, some more guidelines. Wave 4 stops often at the wave 4 of a lower degree. So what do I mean with that? Sorry about that. I should have had a slide here. Let me quickly change that. One second, folks. Here. All right. Wave 4 goes to the origin of wave, goes back to the previous wave 4. So let's say here, black wave 3 finished, we have a black wave 4. Where does black wave 4 stop? At the previous wave 4 of the lower degree. All right. That is a guideline. We know that a rule is that wave 4 cannot go back into the territory of wave 1. That's a rule. But a guideline is that it will not break this bottom. So obviously that's a very useful guideline, because that shows that the blue line is important, not only the red line. All right, so that's a useful guideline. How about the next one? Waves 1 and 5 are often equal. So if you have an idea about what the length is of wave 1, then you have an idea about what the wave 5 could be on average. And that's a good target. Wave 3 is often extended. So you could be, it's one of those moments where, for instance, leaving your TP open could be good because price often pushes further. Typically, corrective waves are more difficult to read. So when there's a correction going on, it might be smart to avoid that because it's more difficult to understand what's going on. Waves have alternations. So if one wave is deep, most of the time the other one is shallow. If one is long, the other one is short. One is quick, one is slow. All right? Those are guidelines. All right, but regarding the rules, remember that wave 3, once again, wave 3 is never the shortest, but also typically has the steepest angle. It's typically the one where you see the most aggressive, steepest price action. All right, that's a guideline as well. But it cannot be the shortest. That's the rule. Wave 4 cannot enter into wave 1, and wave 2 cannot break the origin of wave 1. That's basically the rules. And a few guidelines that I just mentioned. All right, so for some maybe new stuff, for some a rehearsal, no idea, but I had to do it because it's a two-part webinar and I wanted to try to cover as many bases as possible. So this is it. I discussed the basics, the kind of the psychology quickly, how I think that, how to take it, how to tackle it step by step and make it practical for your own trading, how to label it. And next week we're going to take it a step further and dive into more advanced stuff, and I'll try to dial it up a bit for those that maybe know a bit more about waves. All right, that's next week, 13th of August. The swim levels for wave C, I use minus targets minus 272 and minus 61.8. If any targets are unclear, I can send you a free Fibonacci ebook. Just send me an email to chrisforsick@hotmail.com and I can send it to you. More about that on fibs is there. And for those perhaps looking at the recording, Let's see. Here's my email right there. If you need help on that, all right? All right, well, thank you so much for being here. If you have any questions, still let me know. But in the meantime, trading room, webinars, of course, helping with theory, putting that into practice. And we have them on Mondays, Wednesdays, Thursdays, Tuesdays, Wednesdays, and Thursdays. Well, at least normally, not this and next week. But we have live webinars on Fibonacci and waves, I think the first Tuesdays of the month. And we have daily wave analysis and weekly wave analysis, so that's something that you can use to continue. Make sure to take a look at Admiral Markets on social media. And well, I hope that if you had some skeptics about waves, that you can see the value, that you can see how you can use it in a practical sense, and you can learn it step by step without taking too much, doing too much in one shot. So I hope you can see the value of that. You can see that it gives an extra addition to your trading, and I hope that I emphasize that it's important to build the experience and not aim too far, and really take it at the core and build on that. So next week, hope to see you then. I wish you all still a good weekend and perhaps good trading, although watch out, tomorrow's NFP. And hope to see you soon. Cheers.